everyone. My name is Medha. I'm the founder of Wealth Up, and I'm so excited to have another conversation with you, which is related to personal finances. So today we're going to be talking about something which I've seen on LinkedIn has been trending because of generally the conversation around bonds, etc. But we came up with the idea of talking about this way before the regulators decided to make changes. And we were so excited to have Anshul come and talk about fixed income and specifically bonds with us, because there cannot be a better person to talk about this, more knowledgeable on this topic. But before all of that, let me first call on Ankit, the host for today. Ankit, if you can introduce yourself, and then I'll get Anshul to introduce himself. So over to you, Ankit.
Hi everyone, this is Ankit. I am an engineer from Bits Pilani, and after that I was working as an investment banker with Swiss Bank in New York. Now I'm running Wealth Hub along with Medha. So that's kind of it.
Hi everyone, I'm Anshul Gupta. I am the CIO at Wint. Wint is a SEBI-regulated online bond platform wherein retail investors can invest in different kinds of bonds issued by different companies, giving a yield of around 10 to 11.5% with ticket size as small as 1,000 rupees. I've been in the bond market for almost a decade now. Before co-founding Wint, I was in the bond industry, but uh, structuring bonds mostly for institutions. And there is when we thought we should democratize the market, and thereafter I co-founded Wint along with my other co-founders.
Great. Thank you so much for joining us today, Anshul. Really great to have you here. And bonds is something sort of a little new to for most of us, for most of the retail investors. So I think the very basic question: what are bonds in very layman terms?
Sure. I mean, bond is a kind of a financial jargon. So let me draw a parallel here. I think most of us understand what a loan is. Uh, let's say when we need money, we go to a bank. The bank gives us money, and in return we pay bank EMI, which is we return the principal portion of the loan that bank has given to us, and additionally we pay a coupon, which is bank's income for giving the loan. Bond is very similar to how a loan works. When you invest in the bond issued by a company, you are essentially becoming a lender to the company and giving money to the company, which the company can deploy for its business activities. And in return, you get something called as coupon, which is the interest income that you earn for investing in the bond. So bond is very similar to how a loan works, just that it's a financial jargon. It can be traded, can be sold, etc. But underlying characteristic is very similar to a loan. And from investing point of view, it becomes part of the fixed income portfolio of the investors, in the sense that your returns are predetermined. Let's say if you're investing in a bond which is giving 10% coupon, over the tenor of your investment, you will earn 10% fixed income. So that way, it becomes part of the fixed income section of the portfolio of the investor. And like I said, like a bond is very similar to how a loan works.
Right. So irrespective of what's happening in the market, how the economy, I mean, to the large extent, how the economy is performing and what's happening outside the country, for the wars and elections and whatnot, this is pretty stable. I know what I'll be getting back.
Correct. Equity,
So,
like we know, is a volatile asset class. One day Sensex will be a 1%, other day it can be down 1%, so on. But
right.
a bond, like other fixed income instruments, it gives a stability to the investor's portfolio. Investors know that if a bond is giving me 10% coupon, in the next 1 year, 10% is going to be my returns from the investment. So that way, it's
Right.
a non-volatile asset class.
Right. So something, I mean, to Indian investors, we can see to very similar to something like fixed deposit, that we put with banks.
Yes, very well put. Again, FDs are also part of the fixed income portion of the portfolio. Bonds also fall in the same category. I think the main differences will be FDs are almost risk-free, at least up to 5 lakh, since up to 5 lakh per bank per investor. It's covered by RBI insurance, RBI subsidiaries insurance. Bonds, on the other hand, they are not risk-free instruments. Uh, so like in a loan, if you are giving a loan to someone, if the borrower faces extreme financial stress, there is a possibility that the borrower may not be able to repay back the money in time. Similar risks exist in bonds as well, what we call as
Mhm.
credit. There are structures to mitigate the risk, reduce the risk for the investors. But yes, bond is a moderate risk instrument, while FDs are essentially risk-free instruments. Having said that, since the investors are taking some amount of risk, the returns on the bonds are definitely on the higher side. Nowadays, SBI FD may give you like 7.25 to 7.5%, which
Mhm.
is maybe like a couple of percentage point higher than inflation. Inflation nowadays is around 4.5 to 5%. On the other hand,
Well, on
bonds,
paper, yes.
yeah, yeah. At least on paper, the inflation is around 4.5 to 5%.
Yeah.
So in FDs, you're getting maybe 2% higher than inflation rate pre-tax. Good quality bonds are nowadays giving around 10 to 11% returns. So the returns are substantially higher than what a SBI FD will give to the investors. And that's the premium for taking that incremental risk in a bond compared to FD.
And probably, I mean, my next question was actually, okay, if I'm already putting money in FD, why would I go there? But I think you already answered that incremental return that probably that we can get, right?
Correct. I mean, like, see, like, we, at least I personally believe, like, all different asset classes, they have some place in your portfolio. So it's not like it's not a binary situation. Okay, whether I should put money in fixed income or equity, within fixed income in FDs or bonds. It's like
Mhm.
a buffet. You need like all kind of things on your plate. So what bonds do is they help your help the fixed income portion of your portfolio beat inflation returns, even post-tax. While
Right.
FDs are beating inflation maybe pre-tax, but if you look on a post-tax basis, the returns are almost zero. They are matching
Yeah.
what the inflation is giving. But if
Right.
you add some portion of allocation to bonds, even the fixed income portfolio will end up handsomely beating the inflation returns on a post-tax basis. So they help increase the returns which the fixed income allocation in your portfolio is generating.
So I will come back to this one about the buffet part, but before that, you mentioned about risk. So risk. How do you quantify risk if there is a way, or as a retail investors who don't know much about bond, how can I assess what the risk I'm getting into?
Sure. I mean, rating is one part. Uh, so we have something called as rating agencies in the market, and rating agencies, they give their independent assessment or opinion on the credit worthiness of different bonds which are there in the market. And how do they quantify it? Is they assign something called as rating to the bond, and rating is a scale. So the highest rating, which means the safest bond, will be rated at AAA. Government of India, for example, is AAA rated.
Mhm.
Reliance, which is one of the largest companies in India, is AAA rated. Then comes AA category, then comes single A, then triple B, then double B, then single B, then C, and then D. Anything below triple B is considered non-investment grade. So, firstly, retail investors should only
Mhm.
invest in investment grade rated papers, which is either triple A, double A, single A, or triple B. So, top four
Right.
rating categories are considered investment grade. Anything below
Okay,
triple
so
B, which
four out
is
of eight that you mentioned, the eight are there, four are
correct.
good, and shouldn't be getting
Correct.
into the bottom four, bottom half.
Correct. Bottom four, which are double B, single B, C, and D, these are considered junk bonds or non-investment grade bonds. So you can look at a rating of the bond, which is the independent opinion of a SEBI registered rating agency, to
Mhm.
analyze how that third party is evaluating or underwriting or quantifying the risk in the bond. But we believe like investors should do their some bit of their own underwriting, own assessment as well. And within that, you need to look at in which company you are investing, who are the promoters, shareholders, who are the other lenders of the company. For example, is the company able to borrow money from other marquee lenders, let's say mutual funds, banks, foreign investors, etc. It gives a comfort point that okay, those institutional investors are also giving money to the company and would have done their own diligence, and the company has been able to pass the filters diligence of these large institutions as well. So there is some kind of validation that okay, these institutions have done their own underwriting, so we can take some comfort from there. Additionally, you can look how much debt the company has taken In India, most of the bonds are issued by NBFCs, which are non-banking finance companies. Uh, so we, like NBFCs, where leverage is below 4 times. Anything beyond 4 times is a red flag. So we retail investors can avoid those NBFCs where leverage is, let's say, more than 5 to 6 times. So these kind of at least thumb-based financial underwriting or assessment is something that investors can also do. In addition to looking at who are the other lenders, what is the rating of the bond, etc.
Two questions here. Earlier in one of your previous interviews, you mentioned credit rating is not sort of wholesome and as well as it's not most updated. So apart from what you mentioned, like, see, it's also like retail investors. First of all, they don't understand the finances very well, how to download the latest, financials, and because all the issue may not be public, so the financials may not be very easily available. And secondly, he just reading the finances, how, so we are talking about leverage, right? So debt to equity ratio, how much of that leverage is, but people may not understand what is the right number to pick and what not. So is there, apart from credit rating, because as I was saying, it's not mostly updated or not reflecting the market situations, is there any other metric that people can look at to understand what is going on, or easier way to look at for a Aam Janta?
Uh, See, there is no like a one answer to this. Uh, the assessment of the bond will include like looking at the financials of the company, understanding some bit of business, in which business the company is operating, uh, who are the other lenders, who are the equity investors, etc. And now this information is like very easily accessible via bond platforms like Wint and others as well in the market. So if the investors go to any bond platform, all these things that I'm saying are easily accessible in a non-technical manner. Like what is the leverage? The information will be there on the bond page. Who are the other lenders of the company? That information will also be there. The financials will be there in a very easy to understand format. Uh,
And it is
the
updated
latest,
like every
the
quarter or.
Correct, correct. The latest quarter numbers are there. And if someone wants to really understand in detail about the company, there is something called as information memorandum. So when the bond is issued, it's a fairly exhaustive document which any company has to prepare before issuing the listed bond. And even that document is there in the asset page of the bond at various bond platforms. So that document, it's like almost a 100-page document giving detailed commentary about the business of the company, historical performance, latest quarter financial data. If it's a bank or an NBFC, what are the NPA numbers? Who are the other lenders? Who are the other NCD investors? All that kind of entire history of the business is definitely accessible.
A lot of complicated terms. But given the time that we have, we won't be able to cover that. But ठीक है, so information memorandum comes when the issue is happening, right? But on the platform, will the numbers of financials be updated like quarterly? Generally, is that the case?
Yes,
Quarterly
yes,
or?
it is. It is.
And the next question here was, is there a way I can understand so today in the market easily, if I can understand, not going through NSE and looking at the details of the trades, but easily, okay, so for AAA rated bonds, generally what is the yield that I should be looking at? Like something that is easily available, not looking at individual trades that are going on the NSE.
Yeah, so I mean these yields change as per the market, but I'll tell you like today's scenario, Government of India bond is giving around 7%. A good AAA bond is giving around 7.5 to 8%. A double A rating, which is the second highest rating category, is giving around 9%. Coming to
Okay.
A category, which is the third most trustworthy rating category, they are giving around 10 to 11%. And then comes to triple B, which are giving around 11.5 to 12%. And these are the
Okay.
four investment grade rating
Understood.
categories. So highest is giving 8%, then 9%. Third is giving around 10 to 11%, and triple B is giving 11.5 to 12%.
That's a good sort of thumb rule to have if you're thinking of coming across any investment in the fixed income, whatever it is, be it bonds or anything for that matter, just to understand the kind of return that we can expect. Quite cool. So now moving on, like generally the fixed income market in India has been evolving rapidly. A lot of regulations are coming up as well. as you were mentioning earlier, and retail participation is also increasing, reducing the ticket size and what. Now, what do you think are the key drivers in this evolution?
Uh, I think the most important driver is the regulatory support. Uh, I know like fintechs in India have been fearing regulation to a large extent, but at least this is one space where there is regulatory tailwind and not a headwind, which means the main regulator, which is SEBI, is super excited about the space. They have done like a lot of reforms over the past 3 4 years, and now if you look at bond platforms, it's like doing shopping on Amazon. Like earlier,
Right.
bond used to be a very institutional product. Like
Yeah.
to invest in a bond, you were required to have, let's say, a few crores of rupees. Like, but today, on bond platforms, you can invest as low as $1,000 as well, and it has been
Right.
possible because of the regulations that SEBI has evolved over the past 3 4 years. That even a HNI product is now accessible at a 1,000 rupee ticket size, and it comes directly in your demat account. There is no counterparty risk of purchase, etc. And
Mhm.
even the payments go directly from the company's account to the end investor's account. It's not like the company pays to bond platform transfers
Mhm.
money to the investors. So that
Mhm.
infrastructure layer has been like developed pretty well in the Indian market. Secondly, I think the FD rates in India have been definitely on the lower side. Like I said, on a
Mhm.
post-tax basis, you hardly get anything meaningful by investing in a FD. While bonds are able to give you a good delta compared to FD, they are able to handsomely beat inflation even on a post-tax basis. Like I said, a good A-rated bond having a tenure of 12 to 24 months is giving easily giving 10 to 11% or even 11 quarter kind of returns in today's market, which is pretty healthy. uh, if we look at like equity markets, which are like which market says is like pretty expensive nowadays,
Yeah.
uh, I think bonds over the next 1 to 2 years can end up outperforming even the equity returns. Obviously, in the over the long term, equity will definitely
Mhm.
beat the bond returns. But considering
Mhm.
what the equity valuation is nowadays, a lot of market participants are saying that bond returns can give higher returns compared to equity markets, at least over next 1 to 2 years.
No, when you said about earlier, it was only available to HNIs and stuff. I mean, I remember in 2016, I was talking to my banker, and I asked, okay, so I want to invest in bonds, fixed income product, and they said, the minimum investment size is 50 lakhs, and I was like, okay, putting 50 lakhs in just one investment is not something I was comfortable with. And that is why, I was not able to invest back then. So it's, I can completely understand, more retail participation coming in with a small ticket size. Makes sense. Makes sense. All right. Now, you mentioned that, about the buffet part in your portfolio. Now, in terms of the debt portion, if, say, if I'm a moderate investor, moderate risk taker, within the debt portfolio, taking exposure in bonds. I mean, given it is newer and I'm moderate risk investor, what is the percentage of the just the debt portion that I can that I can put in bonds?
Sure. I mean, like, see, personal finance is personal, so there is no right answer.
Yeah,
Uh,
yeah, of course.
but some thumb rules that we follow is like the fixed income portion in the portfolio should be equal to at least your age. Like if you're younger, you can obviously
That
take
is not a
much more.
question that I'm even getting into because
I'm
again,
coming to the second part. Yeah, yeah. I'm coming to
acha,
the
okay,
second part. Yeah.
okay.
So firstly, the fixed income portion should be at least equal to the age. If you're younger, you can take much more risk, so have higher allocation in equity. But obviously, as
Mhm.
you age, you need to protect your portfolio, so have higher allocation in the fixed income.
Right.
Within fixed income, at least personally, I have like around 50% allocation in the bond. But I'm like I understand the space a bit more. I've been in the space for almost a decade, so like I'm comfortable with that kind of risk. But for new
Mhm.
investors, we suggest that maybe around 20% of the fixed income allocation can be in bond to begin with, as they understand the product better, as they gain more trust, more confidence in the product. Gradually, the allocation can be increased, but maybe a 10 to 20% allocation of the fixed income portion of the portfolio is
Mhm.
a good starting point.
Okay. And when I'm making an investment in a bond, should I also be looking at key? So say I have allocated 20% of my debt portfolio for bond. Should I also restrict what portion of this is going to one issuer? With issuers, how should I diversify?
Yeah, at any point of time, I think there should be at least five issuers, what irrespective of the size of your portfolio. Obviously,
Okay.
higher the diversification, lower is the risk, and it's especially true for bond as a product. Try to diversify as much as possible. If you are investing in one bond, I think it's a big mistake that you're making.
Okay.
uh, Start your allocation thinking. Ultimately, you want to have at least five, if not 10, bonds in your portfolio.
Okay. So there is no concept of over diversification in bonds, is what you're saying.
It will come with operational hassle, but there is no harm in diversifying as much as possible.
Okay. That's sort of unique compared to equity, because beyond a point, it's also like if you want to create real wealth, using equity, while it should be diversified, it should also be sort of a focused kind of portfolio. It's not like you should have 50, 100 kind of stocks. So that's it's kind of different. Of course, operational challenge that you mentioned that of course will come into picture. Okay, and when I'm starting with, should I start with AAA or?
See, personally, I'm not a big fan of AAA bonds. I'll tell you my reasoning. Like I said, AAA bonds are giving you around 7 to 8% returns,
Right.
and uh, even though it's a AAA bond, it's not like a risk free. I mean, like it's almost impossible that Reliance will default, but probability is not zero, right?
Right.
On the other hand, there are FDs in the market which up to 5 lakh are government guaranteed. So
Right.
there, they literally the risk is zero, and those are
Right.
giving maybe same returns or even higher in some cases compared to what a AAA bond is will give. And
Mhm.
FDs are liquid, like you can pay a small penalty and withdraw the money at any point of time. While a bond is not completely liquid, it depends on
Mhm.
whether there's a buyer on the other side of the exchange or not. So we believe, like, rather than investing in a AAA bond, you might as well park that money in a FD, because the
Okay.
return is similar or maybe higher. Uh, Definitely higher in small finance banks, which are giving up to like 8.5 to 9% returns, and those are more
Mhm.
liquid. A rating category is when the things become much more interesting, and you're able to generate some additional value for your portfolio. You're getting around, let's say, 10.5 to 11% returns, which is definitely
Mhm.
higher than any FD will give, any bank FD will give. The returns are
Right.
also manageable. So the risk return profile in A category bond is something which starts adding value to the portfolio. In AAA, I think one can definitely avoid, because FDs are giving higher return, and those are literally like zero risk. It's government guaranteed up to 5 lakh per investor per bank.
Okay. So even as a new investor, A is something that I should, be comfortable with. Like I can start
In
with.
AAA, AA, like there is no incremental benefit which bonds are giving compared to a bank FD.
Self-fund. And is it something like triple B that I can also kind of explore, or to avoid that to start with?
To start with, I think like try A category bond. As you gain more confidence in the product, you get better understanding of the product, your assessment improves over time, then maybe come to triple A.
And you also mentioned about the tenure. You mentioned like 12 to 24 months is what you mentioned. Generally, what is the trend that you're seeing? Suppose I'm 30 years old, and I was kind of a stable job, making decent money. I don't need the income or the returns from in my bank, or I don't need to spend it. So I have a more longer term view. Should I still be investing in bonds that are like 1 to 2 years tenure, or something longer, or if there is a product like that?
Uh, See, since these are like not risk-free bonds, if you're investing in a 1 to 2 year bond, the risk significantly reduces. I mean, the risk that a company will default over a 10-year period is much higher compared to, let's say, a
Mm.
company going down in next 12 months only, right? It's
Right.
very unlikely a company which is well rated, where we have done the assessment, will go down within 12 months. So purely from
Right.
a risk point of view, risk management point of view, it makes sense to limit the tenor of the bond definitely below 2 years.
Okay. And if I want to invest, I should probably go ahead and buy another bond at that point of time.
Yes, it's like if you want to invest over a for a 4 year time period, at the end of 2 years when you get your money back, redeploy that money again in a 2 year bond.
And this holds true even in current market, India's current interest rate scenario, where we are expecting that the interest rate will be going down. even then we should stick to this strategy?
See, like if you want to time the interest rate cycle, then do that with a mutual fund, with a like a very long duration mutual fund. Don't
Okay.
mix like a duration play with credit play, because if you're taking
Okay.
longer duration with a credit product, the risk
Mhm.
can far outweigh the benefits or the returns you are expected to gain. It's quite possible the interest rate cycle goes down, but what if the
Mhm.
company defaults? Because these are not like risk-free products. So a thumb
Right.
rule is, if you want to have a duration play, if you want to time the interest rate cycle, that okay, the India's interest rates have peaked out, and tomorrow it
Mhm.
can go down. So play that strategy with a risk-free product, maybe with a 10-year GSEC or 30-year GSEC, or mutual funds which invest in those kind of instruments. Don't invest in a 10-year credit bond, which is an A rating category or triple B rating category, for the duration play.
Okay. Okay. Duration means just the tenure that is remaining. Essentially, I can make very layman terms.
Correct. Correct.
Cool. And in terms of we understood the current scenario, and in terms of the future, where do you see the fixed income market in India growing? Say 5 to 10 years. How do you see that?
Uh, I mean, like, see, Indians love fixed income, right? That's why banks are sitting on, I think, 150 lakh crore of deposits, and
Yeah.
equity market is just a fraction of it. So I think
Yeah.
fixed income market is already there. It's booming, I'll say. What will happen over the next decade is a lot of those fixed income investments may move to the bond market, because like like we discussed a couple of times, the fixed income FD is not beating inflation on a post-tax
Mhm.
basis. And as more
Mhm.
and more people become aware of the fact that bonds are now accessible, they start getting awareness, education around the product. I think the percentage allocation of bond in portfolios of different investors will start increasing. So within fixed income, I see a transition happening from FDs towards products like bond.
I think it was yesterday only, no, when the finance minister sort of was asking the PSU banks to make FDs more lucrative, so people start putting money there, because the credit growth for them has been much stronger than how they are getting the deposits. So makes
Correct.
sense. And is there, like, as a retail investor, can I position myself in a way that I can get benefited from this trend?
Uh, in what ways, like maybe explain the question more?
So we have identified that bonds will be something that will be becoming more popular. Is there anything I can do as a retail investor that I can benefit from this trend, which will be taking place over next 5 years, 10 years time?
Uh, so if like uh, the capital moves from FDs towards bond market, the yields in bonds will go down. And
Right.
one can have a strategy that okay, I invest in a 11% bond today, and maybe 3 years down the line, the bond yields will structurally go down, because a lot of capital will be chasing the bonds in the market. But again,
Mhm.
then you need to play the duration, this thing, that you'll need to invest in a long tenor bond, which one should not be doing, at least for bonds in the A and triple B category. So one
Mhm.
can play that story with triple A rated bonds, but I don't think there is like too much meat in that strategy. It comes with its own set of risks as well, because even though the capital may be chasing the bond market, what if the interest rate cycle turns? So there are those other variables also which will come into picture.
Right. So probably, what we were talking about in terms of the interest rate play, because yield is one factor and interest rate is, going to be another, because yield is also being impacted on the amount of money that is chasing this. So what you said earlier, maybe the longer duration via mutual funds may help as the yields are
Correct.
going down. The sense. Makes sense. And okay, so you have been, in the market for bonds market for like over 10 years. What is generally what you have seen the common mistakes that people are making? How to avoid that, so that again people can be more aware of it.
Yeah, I think, see, greed is good, but greed is good in moderation. Uh, Chasing, being like too much greedy is never good for any investor. So while one should be seriously looking at bond as a product, but one should definitely avoid junk bonds. If you see a bond offering 17-18% returns, even though it may be getting marketed as fixed income instrument, don't even touch that kind of bond. So stay in A rating category, maybe triple B category. Don't go into the junk bond category if you're not a sophisticated investor. So maybe
Mhm.
that is one thing which investors can definitely avoid. Uh, in fixed income, don't try to chase like crazy returns. If a fixed instrument is giving 10, 11, 12% return, that's good enough. If I want to generate maybe returns higher than that, I'll enter the equity market.
Makes sense. Makes sense. Okay, now let's quickly, get into Wint. Wint is, of course, making a lot of creating a lot of space and market in the bonds space of fixed income space. So when it comes to your philosophy, so what's your philosophy when it comes to the bond products, the curated bond products that Wint is bringing to the investors?
Yeah, I mean, like you correctly mentioned, Wint is a curated platform, which means ki it's not like any and every bond can be listed on the platform. We have an in-house risk team which does the diligence of the bond before any bond gets listed on the platform. And some of the things that I mentioned, they are definitely part of our investment underwriting frameworks. We analyze what are the systems, processes, operations of the company, who are the equity investors, promoters, what is the market feedback, who are the other lenders, how the uh, NPA numbers are shaping if the issuer is a bank or NBFC, what's the leverage of the company, etc. So those kind of underwriting checks we do while assessing the bond. And most of the bonds on the platform are exclusive deals, which means if a company has issued, let's say, 20 crores worth of bond, that there's a good probability that bond is available only on Wint Wealth. Uh, so we invest in the entire bond from our balance sheet, and then in secondary we'll sell it down to the investors. And so far we have done roughly more than 2,000 crores worth of sale on the platform. And till date, there hasn't been any delay, any default to the 56 odd thousand investors who have invested in different bonds, we have brought on the platform over the past 3 odd years.
That's impressive. I mean, you were mentioning like generally 10 to 12, 12 to 12, 24 months is generally the tenure. So a large part of, the investments, initial investments must already be over and no defaults. So that's pretty impressive.
So out of this
So
2000 CR, roughly 1,200 crores has been repaid back to the investors.
incredible. Very nice. Okay, so Anshul, you were also mentioning that in the bonds market, NBFCs are someone who issue a lot of bonds, right? Sort of more regularly as well. You guys, I mean, Went focuses only on NBFCs or NBFCs as well as non-NBFCs?
No, so far we are focusing only on NBFCs. So if you look at the bond market and bifurcated sector-wise, NBFCs are by far the largest issuers in the bond market. And the reason is for NBFCs, cash is the raw material because their business is to give out cash to their end borrowers. So they are always in the bond market. Their business models are much more stable. One can analyze the model much better, while for entities in the other sectors, the business models are more idiosyncratic. Like a company may be in manufacturing, trading, servicing. Within manufacturing, you have like so many sectors. So, and those companies may need to borrow on a one-off basis. Let's say the company wants to purchase a machinery, that's when the company will hit the bond market. So while NBFCs on the other side, every month they are in the market because for them cash is the raw material. So that's
Makes
why we have
sense.
taken a conscious call. Let's first develop the NBFC bond market, and then over time we'll diversify into other sectors as well.
So that's the only reason for you being more
Correct.
inclined towards NBFCs. Okay. And as a retail investor, does it matter to me whether it is an NBFC or some other business?
Not necessarily. Whatever risks are there gets factored in the rating. So within NBFC, there'll be like NBFCs operating in, let's say, housing finance, MSME finance, microfinance. So you even within NBFC sector, you can definitely diversify easily. So the five investments you are making, maybe one can be in consumer finance, one can be in MSME finance, one can be in vehicle finance, one can be in home finance, one can be in gold finance. So that diversification can very well be achieved even in the NBFC sector also.
Makes sense. Makes sense. And of course, as you bring more non-NBFCs as well, that avenue will also Makes sense. So now, the investors that you have on your platform, like, do you ask them to first check their risk profile and then suggest, you should be going with these rated bonds? I also understand that you can't advise as such, but because licenses and stuff. But anything of that sort in terms of checking the risk profile?
No, there isn't any advisory which is given. So what we have done is all the bonds that are coming on the platform, we do a detailed underwriting, and within those cherry pick bonds, then it's up to the investor in which bond he or she wants to invest. So it's a
Is
DIY
it more
kind of,
like DIY?
but the basic underwriting is done for all the bonds that for all the bonds by our in-house risk team.
Okay. And within your user base, is there a trend that you have seen, like the kind of the folks that you have, are they more inclined towards single A, triple B, double A, anything that you have seen so far?
No trend is such, like since it's a large user base, there are different cohorts of investors which are there. Some of the conservative ones will be investing in short duration bond, lower tenor bonds, and maybe in the higher rating category. While people with a slightly higher risk appetite, they may be investing in higher yield bonds. So, uh, there are different kind of cohorts amongst the user base. No larger trend as such that we have seen.
But all the bonds that you bring, all of them are secured, right? Is that just what I read?
That's correct. So bonds can be of like different categories. One can be senior secured bond, which are the safest. Second
Right.
category is senior unsecured. Then there is something called as junior bonds, or in financial terms, subordinated bonds. So retail investors, in my opinion, should invest in only senior secured bonds. These bonds have some kind of collateral backing the investment, which means in the hypothetical unforeseen scenario, if the company were to face any stress and the company is not able to repay back the money, there is some kind of collateral which can be sold in the market to recover money. While senior unsecured bonds and subordinated bonds, they don't have any security, any collateral whatsoever. You are banking
Right.
on the fact that the company will survive and will repay back the money to the investors. Now, why senior and why not subordinated? If the company were to go bankrupt, were to default, all the lenders stand in a queue, and who stand at the at the beginning are the senior bondholders. If you are a subordinate or junior bondholder, you will stand at the end of
Mhm.
the queue. While the senior
Right.
bondholders, as per law, as per regulation, they are the first to get their money back. So only invest in senior bonds and secured bonds. Hence, senior secured bonds are the safest bonds.
So even triple B are the safest. So even if they were to default, I have some collateral, right?
Yes, within the rating category, obviously. I mean, one can't say that triple B senior secured is safer than a triple A unsecured. But
Of
within
course,
a
of
rating
course.
category, the senior secured bonds are the safest. And any senior secured bond will have some kind of collateral, irrespective of the rating.
Okay, so if say there is a default, say for a single A or triple B, what kind of loss that I can be looking at, like percentage terms?
So, there haven't been like too many defaults in the market. So, the sample size is on the lower side. So,
Mhm.
difficult to give out a number per se. But I'll tell you the factors which will determine what kind of recovery the investors will get. One is how strong is the collateral backing
Mhm.
the bond. How strong and how big is the collateral? So at
Okay.
Wint Wealth, we have security in almost all the bonds, which is 1.1 times our investment amount. So there is
Okay.
10% extra collateral which is taken. There can be bonds in the market where the collateral is, let's say, one times. But I think investors should invest in those bonds, whereas there is some kind of buffer. It shouldn't be equal to the amount we are investing. So 1.1 times
So
is something
Anshul,
that,
question here. Key, suppose the total value size is 100 rupees, the collateral size is 110, and the this is more like EMIs, right? So the principal amount is also coming down. So say almost half tenure has passed, so roughly 50% of the 50 rupees of the principal has been repaid. Will the collateral broadly or roughly be still valued at 110, or adjusted for depreciation, if any, or that also comes
it's
down?
it's 1.1 times the outstanding amount.
Achha,
So if
okay.
it's going below 1.1 times, the company is obligated to replenish it.
Okay.
And this
Um,
exercise happens on a monthly basis. If the collateral has become, let's say, 1.2 times because the bond is amortized, then the company can take out some part of collateral. And what they
And
can
do they?
add and what they can, they do. And what they add and what they can remove is predefined at the time of issuance. It's not like any kind of collateral they can give. So for the NBFC, the collateral will be the loans that the NBFC has given to the end borrowers. So while adding collateral, there are strict checks like only borrowers of this much CIBIL can be part of the collateral pool. Single borrower concentration can be this much. If a borrower is defaulting, the borrower has to be replaced with a non-defaulting borrower. So those kind of checks and balances are part of the transaction structure. And any addition or deletion of collateral is again guided by the transaction structure.
Super helpful. Now, Anshul, one question that essentially no founder wants to, likes to answer. Say I have invested X amount of money via Wint Wealth, and due to whatever reason, Wint Wealth is not in picture. Whatever may the reason be, right?
Sure.
What happens to my investment?
It's completely safe. Like I said, there is no counterparty risk as such that you're taking on Wint Wealth or any other intermediary. The only risk is you're taking is on the end company in whose bond you're investing. As long as that company is surviving, the investors will get their money back. Because when the company is repaying back the money, it's not like they make the repayment to Wint Wealth and Wint Wealth passes on the money. There is
Right.
a SEBI registered trustee which is appointed to coordinate between the investors and the company. Having said that, the payments directly grow from the company directly to the end investor's bank account. So when the investor is investing in the NCD, investor's demat account along with the bank account details of the investor, which is linked to the demat account, gets shared with the company uh, uh, by the existing infrastructure which is there. So company has the end investor's bank account details and they know how much the investor has invested. So on a monthly, quarterly, half yearly, yearly basis, the company directly makes the repayment to the bank account which is linked to investor's demat account. Like how it happens in equity shares. When there is a dividend,
Right.
the money directly comes in investor's bank account. Similarly, in bonds as well, the principal repayment and any coupon repayment directly comes in investor's bank account.
Right. So as you mentioned, Wint Wealth is an intermediary, just a platform. It is not taking any money from any of the investors. Straight away goes to the issuer,
Correct.
right?
Correct.
Sense. Makes sense. All right, cool. And so, Anshul, going forward, what's the new or what's sparking thing that's opportunities that are happening, and what are you guys working on going forward?
Yeah. So till like 2 months back, the ticket size of bonds used to be 1 lakh. Uh, like last month only, SEBI has further reduced the ticket size to 10,000. Uh, so now what we as a team are doing is most of the new bonds which are coming on the platform, they'll have a ticket size of 10,000 rupees, so that investors can invest more, diversify more, try out the product at a lower ticket size. And a lot of good A and triple B rated bonds are lined up for the platform. Already there are like 4 5 live bonds which are there on the platform, but the idea is to add more and more companies, more and more cherry picked bonds on the platform so that the investors can diversify more. Additionally, we have also brought in a small finance bank FDs on the platform. So like I said,
Okay.
even FDs up to 5 lakh are government guaranteed. So there
Mhm.
exists a arbitrage. SBI FD is giving, let's say, 7 quarter to 750, but there are a lot of mid-sized banks where the returns are as high as 9%, and those banks are also covered by the insurance up to 5 lakh per investor per bank. So for
Mhm.
investors who are seeking low risk investments, they don't want to, let's say, the moderate risk that comes in bond, they can invest in those small finance bank FDs and get returns up to 9%. For investors seeking moderate risk, moderate returns, they can invest in these senior secured bonds, which are giving returns in the range of 10 to 1150, 1175.
Makes sense. Makes sense. Okay, super helpful. Thank you so much. I have registered on Wint Wealth, and I was going to make the investment. Some hiccup happened, and I'm talking to my relationship manager. Small little hiccup, and then I got lazy, so I haven't invested. But we'll be doing that soon. I really want to try out the product. Okay, thank you so much, Anshul. This was very helpful, and we'll be sharing the recording as well with our clients so that small little the basic questions that they have they can get answered, and I hope that of course I'll be talking to them, how they can explore this, and I'm looking forward wherein they can start asking me questions. Ki, hey, I read about this or watched this. How does it work, and how is it that we can get started? So exciting times for the bonds market.
Thanks, Ankit. Thanks for having me. It was a lovely conversation. Hope to have many more conversations in the future as well.
Absolutely, absolutely. Thanks for your time. Thank you, Metha.
Yeah, thank you so much, Anshul, for your time. For everyone else, this was the second episode that we did, which was on bonds. Next week, we'll be talking about invoice discounting. So do join us. I'll be sharing more details. You can follow Ankit for that. And if you have any questions about Wint Wealth, how to invest, or if there are things that you want to discuss, you can DM Ankit or me, and we'll be happy to help you with that. So thank you so much. Good night, and have a great evening, everyone.
Thank you, everyone. Thanks, Anshul. Thanks, Metha. Bye bye.
Thank you. Bye.